Today, we're starting talking about customer due diligence, so we'll have a bit of a refresher. Many of you will be well aware of your customer due diligence requirements. I just want to make sure that everybody starts from the same agreed upon terms of reference before we talk about the amendment regulation. We will talk about customer risk rating methodology, some examples, your ongoing customer risk rating requirements, how to integrate your customer due diligence and your ongoing customer due diligence with the risk rating, and then some upcoming updates on low risk trust. And I want to talk about that because it's in the future, will happen next year probably, but it kind of fits well with today's topic. So you need to do customer due diligence when establishing your business relationship with a new customer, and when you want to do an occasional transaction or an occasional activity. And when you have an existing customer and you notice a material change in the business relationship and you have insufficient information on the customer, this end is important, and we'll discuss this later when we talk about customer risk rating and ongoing customer due diligence obligations. You also need to do customer due diligence when you, as soon as practicable, after you become aware that an existing customer file is anonymous. And this is, the Act is very much tailored for banks, and this is often some parts of the Act don't apply to all reporting entities. And I think this is a clear example of that, because I think that for the reporting entities in this virtual room, it's unlikely that you'll have a customer file that is anonymous because you know your customer base very well. But you can imagine a reporting entity with thousands and thousands of accounts might have sometimes an anonymous account. Anyway, if it does happen that you find an anonymous file, then you should do customer due diligence. Also, when an existing non-captured customer requests captured services. Now, this applies only to designated non-financial business and profession. If you know who you are, but it's in general, it's lawyers, accountants, real estate agents. These agencies, this type of sectors can have both captured and non-captured services. So when a customer moves from non-captured to captured, then you should do customer due diligence. Everybody else would have all of your customer captured, and so this distinction doesn't really apply to you. When you do customer due diligence, you need to collect information on the nature and purpose of the business relationship. And this information needs to be sufficient for you to decide if the customer should be subject to enhanced customer due diligence. Nature is information on the service you provided. So how much, how often, the volume, the value of the expectation of the interaction with the customer. And the purpose is understanding what this customer is trying to achieve in using your service. This information is important because when you do your customer risk rating, you need to look at the customer as they are. So their structure, their jurisdictional exposures, all of this information, but you also need to look at the nature and purpose of the business relationship with the customer, because obviously a customer that asks for a $1,000 transaction will carry different risk of a customer that engages you for $1 million transaction. So information is important to consider. Other obligation, you need to consider the legal form and proof of existence of the customer, the ownership and control structure, the power that binds and regulates the entity, and any nominee relations. This relates to entities or arrangements like companies, trust, limited partnerships, and this information are company extracts, constitutions if available, trust deeds, things like that. You need to verify the identity of the beneficial owner. You can do that face-to-face, or you can do it through the documentary verification. So you send your customer to see a lawyer or a JP and get the document certified, or you can do an electronic identity verification with a tool, with a provider. You need to check the politically exposed person status of a person, PEP. This is an obligation of the Act. You can do it for a low-risk client. You can do it through open internet searches, for high risk situation, you might need to use a vendor and a list. I added here sanctions checks as well. This is not currently in the AML Act, but there is a plan to include this in the AML Act in the future. I thought it was good to mention here. And also, especially the Department of Internal Affairs said that's something you should consider, especially when you do your jurisdictional exposure risk assessment, to see if you have any exposure to sanctions, to jurisdictions that are under sanctions. So that could be something else for you to consider. Just put it there. We can talk about later if you want. You need to collect enhanced customer due diligence information, so source of funds, any other wire transfer information that you haven't captured already, and you need to keep records. What are occasional transaction and activities? Occasional transactions are threshold-based, and they are usually done by entities like, for example, casinos or money remitters. Those are all transactions that occurs outside of the business relationship with the customer, and they are above a certain threshold. For example, for money remitter, it's like $1,000. Many reporting entities in this virtual room do not do occasional transaction. They're more likely to do occasional activities. And occasional activities are those activities included in the definition of designated non-financial business and profession, and they do not occur within a business relationship with the customer. So in other words, they do not have an element of duration. I'll give you an example. If you are instructed by a customer to set up a trust or to incorporate a company outside of the business relationship with the customer, so without the element of duration, that will be considered an occasional activity. If you do occasional activity or occasional transactions, the compliance program guidelines that came out in October 2024 gave some very good guidelines and kind of explanation. And it said that you cannot do delayed customer due diligence. Delayed customer due diligence is when you open a customer file, but you postpone the verification of identity at a later stage if this is necessary to not disrupt your usual business practices, and if the customer is low risk enough that you can manage the risk. For an occasional transaction activity, you cannot do delayed customer due diligence, and the reason is very simple. If you do the occasional transaction or activity and you don't get the customer passports, you might never get them. You might never see them ever again, so you'll never discharge your obligations. You do not need to collect nature and purpose of the business relationship, including information up to the level of assessing if enhanced customer due diligence is required, but said that all other enhanced customer due diligence triggers still apply. If you do choose not to do occasional transactions and activities, you need to have policies, procedures, and controls to ensure that the occasional transaction and activities don't occur. You need to set up boundaries there. Before I move on, this kind of concludes the kind of overview of what's occasional transaction. So I'll have a look if there is any questions. Someone says that they have no sound. I wonder, maybe check on your settings to make sure that you have your volume up. Otherwise, I'm not sure what the problem will be, because I've got to confirm that the sound was fine. I don't see any other questions, so I'll move on. So far, you had an implicit risk rating, and I'll show you exactly what I mean. If you look into the Act, you can see that you are required to do customer diligence in relation to an existing customer according to the level of risk involved. You need to do verification of identity according to the level of risk involved, and you need to conduct enhanced customer due diligence if you consider that the level of risk involved is such that enhanced customer due diligence should apply to the particular situation. Yes, I have done Control F and looked for every time that the Act say risk. I stopped here. I thought 3 examples were enough. But what I want to say is that implicitly you have been doing this so far. I want to kind of demystify this customer risk rating and what it means, because it's something that you've been doing, but maybe it has been a lot up here in your head, and it's about writing it down and having it explicitly. I've seen a question from Linda. Is there any database we could access to do the sanctions checks? There are certainly databases, and I think that the Department of Internal Affairs suggests a database from the police, but I will need to get back to you with a more precise answer. Moving on, this is what the amendment regulations, specifically Regulation 12 AC of requirements and compliance, say. As you can see, it's very short, but it gives us a lot of information, and there is much more. There is a lot that we can talk about, even though it's only literally 4 lines. So to the letter of the requirements and compliance amendment regulation, you must risk rate a new customer when conducting customer due diligence in the circumstances described in section 14 and 22, so standard and enhanced customer due diligence. And you must keep a record of the customer risk rating and review the customer risk rating as appropriate in accordance with section 31 of the Act, ongoing customer due diligence. We'll talk about these requirements just now. In practice, you need to do customer due diligence on a customer, and the definition of customer in the Act involves both customers that engage you for a business relationship that has an element of duration, and also individuals or customers that engage you for occasional transaction activity. So that's why I made all that distinction before, just to say that when you have a new customer, both there is an element of duration or not, the risk rating should apply to both. And also for returning customers. So from the 1st of June 2025, so that's the line that's time as we experience it. From the 1st of June 2025, you'll need to consider the customers that you onboard after the 1st of June 2025, so the new customer. When I talk about returning customer, what I mean is that when customers that you onboarded before the 1st of June 2025, so customer that you haven't risk rated yet, they come back to you with a new instructions, if there is a material change, if they want a new service, or they want to amend the service you're already giving them. So when that returning customer comes to you, then there is that kind of ongoing customer due diligence requirements, and you should bring the customer risk rating to the level of the 1st of June 2025 new customer. In other words, at this point, I didn't find guidance or anything suggesting that the customer risk rating is retroactive. It's a very much a looking forward requirement. So from now, from the 1st of June onwards, but as customers come back, then you should align them to the customer risk rating. The Department of Internal Affairs and the supervisor said, but mostly I heard from the Department of Internal Affairs that customer risk rating guidelines were coming, and I haven't seen them yet. I was hoping that by today we would have something, but I checked a couple of hours ago and I couldn't find any customer risk rating guidance. So even though there is no guidance that is specifically on customer risk rating, there is a guidance here and there kind of disseminated in other guidance that came up the past year. So we'll go through those. In particular, we start from the compliance program guidelines. Paragraph 54 says that you need to risk rate standard and enhance customer due diligence clients. We saw that it's in the regulation as well. Pretty much, you do not need to risk rate simplified due diligence client, customers and clients. And I think that the reason is because your simplified customer due diligence customers should be low risk. So it's really not, it's really redundant to risk rate them. You have some flexibility. You can use numeric or low, medium, high risk scale. But this is the two examples that the guidance provides. A numeric scale will be, for example, let's say I rate my customer from 1 to 10, where 1 is the lower risk and progressively more until 10, which is the high risk. So that's that's an option. Sorry, I'll drink just a second. So that is an option. You can use that. The other scale present in the compliance program guidelines and suggests is low, medium, high risk, which is pretty much a 3-level scale. I usually use this scale when I work with my clients that are reporting entity and needs to do customer risk rating, because we will see that you need to treat customer in different category differently. So you want to treat low risk customer in a certain way, medium risk customer in another way, and high risk customer yet again in another way. So if you have too many options or too many scales, it might become hard. So I think the low, medium, high, it's a pretty good one. But again, you have flexibility. You can use an automated solution or a qualitative solution. A qualitative solution, it's a kind of a very subjective, and it's about looking at the customer qualities and making an assessment. I think that this solution, it's the closest to what you're currently doing. As I was saying before, there is already, you are implicitly risk rating your customer. You're just not writing it down, most likely. But it's about using your experience and your knowledge to kind of qualitatively risk rate and assess the customer. Automated solution, it's a little bit more complex, and I'll get some examples that hopefully will give you an idea of what an automated solution will look like. Your risk rating process should be based on the findings of your risk assessment. We'll look at that in the next slide. I'll take a break just to look at the chat or see if there is any questions. I can see a lot of not stakes. And then Simon asks, does this need to be backdated for existing customer? And then the following question, Simon, how do you define returning customer? This does not apply to long-term customer. It doesn't simply apply to anyone who stays as a client from 1 year to the next. The first question, if I understand the question correctly, I do not think you need to backdate the existing customer. If we're talking about the customer risk rating, when it's the moment that your existing customer comes around to be risk rated, then at that day you will risk rate the customer, and that's the date. You do not need to backdate it, if that's the answer of the question. How do you define returning customer? That does not appeal to long-term customers. What I'm trying to say with the returning customers, I think you're making a good point, and I apologize if that was not fully clear. So you will have new customer coming from the 1st of June 2025, and that's specific. We talked about that. Then you have customers that engaged you before the 1st of June 2025. You might have a long relationship with them, and they might be kind of there using your services. And then you may have customers that I'll make two examples of two different sectors, and I hope that helps. If you are a lawyer, for example, and you act as a trustee for a trust, and the trust engaged you before the 1st of June 2025, that relationship is kind of ongoing and nothing might happen. Or another example, a customer asks a loan before the 1st of June 2025, so it's a customer and then returns after the 1st of June and asks for another loan. In the first example, as you have that kind of ongoing relationship, that could be a trigger event, or that could be your ongoing review. So a trigger event like something changes in the client structures, or they ask you different, they give you different instructions, or as part of your ongoing customer due diligence, that customer becomes, you need to do ongoing customer due diligence on that customer. That's kind of the point in which you should risk rate them. And the second example is simpler. It's when the customer come back with new instruction. Next question, Matt. How often do we have to reassess the customer risk rating if they are a long-term client? How often do we need to look at? I will touch upon that later in the presentation, but thank you for the question. And please let me know if the following presentation doesn't answer that. Does returning customer mean they have more business or get ongoing advice? Martin, I hope that what I explained before for Simon answer that question as well with the two examples. So in practice, you should recognize these 4 items as part of the Act, Section 58 of the Act, which are the item that you need to consider, the categories that you need to consider for your enterprise-wide risk assessment. I always used to call it just risk assessment, but now that we talk also about customer risk assessment, I think it's important to start distinguishing between the enterprise-wide risk assessment and the customer risk assessment. So the enterprise-wide risk assessment is the overall risk assessment of your business. You will see that 2 items are missing here, which are the nature, size, and complexity of your business and the institution that you deal with, because they don't really apply to the customer risk rating. But we focus, for the customer risk rating, we focus specifically on customers, types, products, jurisdictional exposure, and delivery method. What I was saying before is that your customer risk rating needs to apply, needs to reflect with the enterprise-wide risk assessment. There are some customer types that inherently carry more risk than other customer types. For example, a individual usually carry less risk than a company, and in turn, a complex company structure will carry more risk than a simple company structure. And again, for example, a trust will carry more risk equal to a complex company structure or more than a complex company structure. Product and services, you need to consider the products and services that you have in your enterprise-wide risk assessment and the one that you offer, obviously. I'll do this similar example to before, and I apologize because I know there are lots of people in this virtual room that have different services, and I'm not able to talk about all the services. I will mention some services that are more kind of common, so hopefully everybody can understand. But if you do have a specific question, please do ask me even via email. So for example, if you do real estate property transaction, and you say in your enterprise-wide risk assessment that is a high risk product, then when a customer comes to you and wants to do a real estate conveyancing, a real estate transaction, the customer risk rating must consider that product is high risk, because this is what you said in your enterprise-wide risk assessment. So you need to consider that risk. Jurisdictional exposure. Some jurisdictions are higher risk than others. A customer that is in New Zealand with New Zealand beneficial owners will carry low jurisdictional exposure risk. New Zealand is a low risk country. But if you have a customer that is resident in a high risk jurisdiction or in a medium risk jurisdiction, or have beneficial owners in high risk, medium risk jurisdiction, that should be considered when you risk rate your customer, and the delivery method. So how you interact with your customer. Do you meet them face to face? Have you met that specific customer face to face? Have you not met them face to face? Face to face interaction usually carry less risk. And did they pay you with electronic bank transfer or cash? I doubt or cash, but if that's the case, then you should consider those risks. We're going to look at some methodologies. And I want to make a disclaimer. These are I have 3 methodologies for you: low complexity, medium complexity, and high complexity. And these are I made them up on the basis of my experience with working with reporting entities. Whatever methodology you use, it needs to be tailored to you. So just please take this one as an example. This is a low complexity and is literally a checklist. And this can be used, in my opinion, by a reporting entity that has simple products, ideally one product, and offer services to kind of a limited audience. So here in this example, we say, is the customer individual? Yes, because all customers are individuals. 99.9% of the time, customers are individual, if not 100% of the time. Is a personal loan? Is it between X and Y? Is it in New Zealand? Did we meet them face to face? This is it goes through the same 4 categories that I was telling you before, but it applies to reporting entities that doesn't have much variation. They only do personal loans, customer individuals, loans are small loans. They are in New Zealand, they meet them face to face. The good thing about having a written checklist, it's twofold. First, it shows your supervisor and your auditor that you have thought about what are the items and what are the characteristics to be considered. So it functions kind of an evidence. And then the second is that if you have juniors or assistants or multiple people working in your business, everybody follows the same checklist and everybody should arrive at the same conclusion. So it kind of ensure consistency in your outputs, in your risk rating. Your risk assessment and compliance program should explain how you decided this question or items to check in the list. This is a medium complexity. It's a video. It's working. I'm so relieved. This is something that I prepared working with some of my clients that have already been doing customer risk rating. And it's very much inspired by audits that I've done to reporting entities that have already been doing customer risk rating, especially in the financial market authority space. I saw a few reporting entities that have been doing customer risk rating for years. I think they took very literally that implicit risk rating that we saw in the act before. The way this is just a spreadsheet, it doesn't have to be this complex. It can be even simpler than that. I like making spreadsheets. That's why it looks like this. But the core, the principle, it's that we take those same categories and we break them, those same 4 categories, customer type, services, jurisdictional exposure, delivery method. We take them and we break them in individual questions. And because the reporting entity is a little bit more complex than what we saw in the low complexity, the answer cannot be just yes and no. There needs to be a little bit of more nuance. And because of that, the answers are weighted. So for example, transaction volume, I say 2 to 20, it's 2. If it was 20 to 100, for example, it would have been 3. Over 100, it would be 4. So it uses the same, it uses a methodology to say what's the weight of each item. It calculates them together. It could be, I like to do it like this because it's quite neat, but it doesn't have to be like this. If you want to do something like this, the principle that I want you to remember is that each answer needs to have a weight, which put together will give you a rate. The last option is high complexity, and this can be done by an external vendor, and I'm sure that someone out there are already selling this type of services. They can use automation, so they can use kind of the one that I showed you so far. They're very much manual. So after you're done customer due diligence, or while you do your customer due diligence, you need to go through the process and kind of put things in. An automated system will draw the information from the customer due diligence and put them in the calculation without minimizing your input, which makes things faster for you. And they can use artificial intelligence to analyze previous patterns and predict customer risk rating. This is as much as I'm prepared to talk about how AI can be applied to customer risk rating. This is really not my realm of expertise. And you can consider, if you are looking into something like this, I would suggest looking at your existing vendors, maybe someone that's doing your electronic identity verification, or your outsourced provider are already selling something like this. I don't know, have a chat with them. Before we move to ongoing customer risk rating, I will look at some more questions. Simon, so no backdating required and only going forward for new customer if things can change materially. If this is correct, can you say so in chat? I'd like to screenshot it for future reference. Martin, what abrogation of the risk assessment? Abrogation of the risk assessment can be left to, say, a Kiwi saver provider or managed funds retailer. Nearly all of this have electronic identification facilities. Once this is done, the rest is purely my options. I'll reply to Simon first. As I said, the supervisors have not released guidance on the customer risk rating, and what I'm telling you is what I find in existing guidance and my interpretation of the law and the guidance, and talking with people working in the field. And I cannot pinpoint to you where exactly the answer of the question is. Because of that, I can take a note of your name and get back to you when something is available. I hope that satisfied your requirement. The second question from Martin, I don't know if I fully understand the question, and I would like Martin to ask you to bring it up when we do the kind of voice Q&A, so that I can maybe ask follow-up question or kind of clarifying points. Moving on to ongoing customer risk rating. Again, the compliance program guidelines paragraph 54 says, I'll read that out to you because I think it's pretty good insight. The supervisor consider an accurate risk rating of the customer as key to being able to effectively and efficiently discharge your AML CFT obligations during the subsequent business relationship. Accurate risk rating inform which of your customers require more regular review and monitoring, and which require less ongoing scrutiny. Refer to part 3 below. We'll see that in a second. This allows the most efficient use to your compliance resources and is central to a risk-based approach. So I mentioned it before, the expectation is that you review your customer on an ongoing basis, the high-risk customer more frequently than the medium-risk customers. There is no expectation to conduct ongoing reviews of customers that are clearly low risk in the absence of a trigger. So when you do ongoing customer due diligence, it can be done for two reasons. Either it's your kind of ongoing duty. At some point it happens that you need to review a customer. So if you have a ongoing relationship with the customer, even if there is no trigger, after a certain amount of time, you should still review the customer file. And the supervisors say it should be more frequent when you have a high-risk customer and less frequent when you have a medium-risk customer, and theoretically never if you have a low-risk customer. The compliance program guidelines do not say how frequent high-risk review should be, but I can tell you that from international standards, the frequency is every year. There is no, I've never find any standard that says what medium-risk customer should be reviewed. So let's say in your compliance program, you should have high-risk customer are reviewed yearly, medium-risk customer are reviewed every 3, every 4, every 5 years. I don't know what's the risk appetite. Low-risk customer are reviewed only on a trigger base. So that was kind of the ongoing part. The second part of ongoing customer due diligence is that you need to review a customer after a trigger. So, for example, a customer give you new instructions. They want to change a bank account. You discover that they have a new beneficial owner. Any of this could be a trigger. So for high and medium risk customer, both the ongoing and the trigger applies, and for the law, only the trigger applies. I always say, first of all, I want to say, I think the specification that a low risk customer do not need to be reviewed on an ongoing basis, it's a pretty good step forward. This was not what we understood, or I say we, like, it's none of the people working in the field understood this before this guidance. That was definitely not the general consensus. So I'm happy that this was clarified, because I think it saves time and work for reporting entities. And the second thing I want to say, when you do ongoing customer due diligence, you need to review the customer, but you don't need to necessarily do anything more than that. So if you have a medium risk customer and there has been no trigger and you review them after 3 years, and you go through, like, for example, as a company, and addresses are all the same, you have all the passports, there's no new beneficial owner, it's kind of everything same. If I was a compliance officer, all I will do, it's probably just redo the PEP checks, just because the PEP checks were done 3 years before. It's a bit of time. But other than that, I wouldn't go and talk with the customer. I wouldn't ask them anything. I will redo the PEP checks, write a note that the customer was reviewed, and that's it. Enhanced customer due diligence guidelines say that when a high-risk customer remains high risk, you need to do enhanced customer due diligence. And when a low or medium-risk customer becomes high risk, you should also do enhanced customer due diligence. Enhanced customer due diligence involves having more scrutiny on the customer, having senior management approval, things like that. But mostly it means verifying and collecting and verifying social wealth and social fund information. Social wealth is the overall wealth of the customer. It gives you an idea of the wealth of the customer and how they acquired it. And social fund is the fund for the specific transaction. So if you review your customer and a medium risk customer become a high risk customer, and this was triggered by a transaction, so the customer comes back to you for purchasing a new residence and a new home, and they were medium before and they become high now, I would say that it's important to consider. It's very important to consider the source of fund for the transaction if the tipping off to the high risk customer was triggered by the transaction. And another example, if you're doing kind of an ongoing an ongoing review of a medium risk customer and something happens, you find some adverse media or some information or law enforcement tells you something about a customer, then there is not really a transaction. So the source of fund doesn't make a lot of sense here. It's more the source of wealth. I'm going to speed through the end because I'm mindful of time, and then we'll catch up with the question. But thank you for the engagement. I didn't expect so much engagement with this session. How do you integrate your current enterprise-wide risk assessment and compliance program with the customer's risk rating? First of all, you need to include your customer risk rating methodology. So whichever way you choose it to do your risk rating, you need to think about how you came to that system and kind of trying to write it down and explain how you are going to risk rate your customer going forward. You need to have policies and procedures and controls to say how the customer risk rating tool is used. And I'm saying like very granular here, like who is going to use the tool? Is it the compliance officer? Is it someone else in the team? When is it done? Alongside the customer due diligence, at the end of the customer due diligence, just before the approval, how you're going to do in practice, how you're going to use it. Record keeping, where is the customer risk rating tool held? When is it updated? How often? After a trigger event or on an ongoing basis? Spoiler alert, both after a trigger event and on an ongoing basis. And then you amend your customer due diligence, ongoing customer due diligence, and account monitoring policies, and differentiate between how you're going to treat those low-risk customer, medium-risk customer, and high-risk customer. We talked a little bit about it before, but are you going to have senior manager approval for a high-risk customer? Do you need it for medium-risk customer? How often do you review medium-risk customer? How often do you review a high-risk customer? This is the type of information you need to integrate in your compliance program. This is the last slide. It's about some upcoming changes, and this is about low-risk trusts. It's not currently law, and we do not know when this will be. This was a feedback coming from the statutory review that wanted to kind of simplify low-risk trust customer due diligence, and it was considered to be so important that it was not possible to have it included in the amendment regulation, and the preference was to have it included in the Act. Obviously, it takes a little bit more to amend the Act than it takes to issue regulation. So at this stage, there is a bill, but the last time I checked, we're expecting these changes to be operational April 2026, but I don't know. That's just something I read a couple of months ago. So it's not happening now, but I mention it because I would like it to be on your radar, because when this amendment will happen, you will not need to do source of wealth and source of fund verification for your low risk trust if you're satisfied that standard customer due diligence will be sufficient. It's good in the sense that it will be less work for onboarding a low risk trust. But your supervisor and your auditor now, when they check your customer due diligence on a trust, they'll look for source of wealth and source of fund. After this amendment, they will look for how did you decide that you're not going to get source of wealth and source of fund. So you still need to record the rationale and kind of put some evidence together to explain your decision and to make a case for yourself that was the best approach, that you were satisfied for standard customer due diligence. I'm bringing it up today because you could align your customer risk rating policies. You will need to align your assessment on low risk trust with your customer risk rating policies. So it's good to have it in mind in advance.